Hey everyone, welcome back to another dividend investing video. As usual, I am on the hunt for solid dividend growth stocks. I'm looking for quality companies with a proven track record of growing their free cash flow and dividends and that are trading at a discount. Buying these top tier companies at an attractive valuation sets the stage for long-term wealth, steady passive income, and maximizes that powerful compounding effect. In today's video, I'll be reviewing 3 dividend growth stocks that fit this exact criteria, exactly the kind of blue chip dividend growth stocks I want in my own portfolio for the long haul. So let's dive in. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. All right, let's kick things off with CSX Corporation, ticker CSX. This company is one of the big names in the U.S. rail industry, and it's definitely caught my eye as a solid pick for dividend growth investors in 2025. The U.S. rail industry plays a critical role in the economy, transporting essential goods like energy, agriculture, and consumer products efficiently across the country. With established infrastructure, high barriers to entry, and steady demand, railroads like CSX have the strong pricing power and generate reliable cash flows, making them a great option for long-term investors. CSX is one of only a handful of companies in this space, making the U.S. rail industry something of an oligopoly. CSX specifically dominates in the eastern third of the United States, connecting crucial logistical hubs like Chicago, New Orleans, and Tampa, and they even go into the Canadian provinces of Ontario and Quebec. This gives CSX a unique advantage as it controls key routes that are vital for transporting goods effectively across populated parts of the country. At the time of publishing, CSX shares are trading around $32. They didn't see much movement in 2024 with a slight dip, just over 6%. Now, right now, CSX is hovering near its 52-week low. So could this be a good entry point? CSX hasn't really done much in the last 5 years. Looking at total return, it's up about 42%. And a mix of price appreciation and dividends, that is, right? Now, while the S&P has returned 99%. So yeah, it's been underperforming lately. But if we look at the 10-year total return, things are a lot closer. CSX's return is 229%, while the S&P has brought back 244%. Now, this is all looking backwards, and who knows what's ahead. But here's why I'm eyeing CSX. Now, if the U.S. manufacturing is to see an uptick, which I think is pretty likely with the incoming administration, CSX is a natural beneficiary. More manufacturing means more freight to move, and CSX has the infrastructure to take advantage of that. And as a dividend growth investor, CSX has exactly what we're looking for, a 19-year dividend growth streak, 21 years of uninterrupted dividend payments, and on top of that, they've had a 5-year average annual dividend growth rate of 8%, with their latest raise in February 2024 coming in at 9.1%. Looking at the graph, these increases are pretty consistent, though it did flatten out a bit around 2020, but hey, we can understand why that happened. Now, as a percentage of earnings, CSX pays out 25% in dividends. As a percentage of free cash flow, that number is 34%. For most of the last decade, these ratios have been sitting nice and low, leaving plenty of room for the dividend to keep growing, while CSX continues to invest in its infrastructure, pay down debt, buy back shares, basically all the things companies do with their free cash flow. So overall, this is looking great. Simply Safe Dividends provides a dividend safety score of 85, which is rated very safe and indicates CSX is unlikely to face a dividend cut. This rating was reaffirmed on October 31st, 2024. The CSX dividend is paid out quarterly, March, June, September, and December, at 12 cents per share, bringing their total annual payout to 48 cents per share. And we're expecting a raise when their next payment is issued around the middle of March. The expected ex-dividend was also going to be around the end of February. Those dates have not yet been announced. While this is a nicely growing dividend, it's not necessarily a huge dividend yielding stock. So it's better suited for investors with more time on their side who don't necessarily want more income today. What's interesting is that the current yield, however, of 1.48% is a good bit higher than CSX's 5-year average yield of 1.31%. And this is a sign that it could be an undervalued stock, or at least it gives you a chance to lock in a better than average starting yield in a high quality dividend growth stock. Based on that 5-year average dividend yield, we'd expect the price to fall somewhere between $33 and $40, so it's currently sitting just below the low end of that range. Currently, CSX's PE ratio is sitting at 16.6%, which is near the lower end of its historical range. It's also lower than the average PE for the industrial sector, which is around 20.5. Based on this current PE ratio, CSX would be valued somewhere between $31 and $38. So by this metric, it's on the lower end of a reasonable valuation for the stock. Now, CSX buys back a ton of shares every year, which has led to a steady decline in outstanding shares. In 2014, there were about 3 billion shares outstanding, and today that number is under 2 billion. So it's a reduction of around 33%. And we prefer investing in companies that buy back their shares, as it's a signal of confidence, and it helps increase shareholder value, more importantly. Now, CSX's return on equity is 29%, and its return on invested capital is 14%. These numbers are solid because they show how well the company is using its resources to generate profit. A high ROE means CSX is effectively turning shareholders' equity into earnings, while a good ROIC shows they're getting strong returns on the capital they invest. Both of these figures suggest CSX is a well-run, efficient company, making it a solid pick for investors. CSX has a low net debt to EBITDA of 2.35, meaning they're not overly reliant on debt and can manage their obligations well. However, their net debt to capital is 57%, which is a little bit higher than ideal. This means a larger portion of the company's capital comes from debt rather than equity. While not necessarily a horrible thing, it shows there may be a bit more leverage than some might like. But with that said, it's on par with their competitors such as Union Pacific and Norfolk Southern, so perhaps this is characteristic of the sector. Wall Street analysts have an average price target of $38.66, which represents about 19.5% upside from where the stock is priced today. That's some nice potential upside for 2025. Do you agree that CSX stock looks interesting right now, or perhaps you're interested in one of the competitors like Norfolk Southern, ticker NSC? Personally, I think the sector as a whole has a lot of potential, and 2025 could be a great time to be in the railroads. I'd love to hear your thoughts down in the comments. And if you're looking for a bit more yield than what CSX offers, be sure to check out this next stock on today's list. Next up, let's talk about PepsiCo, ticker PEP. It's one of the biggest names in the global beverage and snack industry, and its stock has consistently caught the eye of dividend growth investors. PepsiCo is not just a soda company, it owns a diverse range of popular brands across beverages and snacks, including Gatorade, Mountain Dew, Tropicana, Lay's, Doritos, and more. This diversity gives Pepsi a stable revenue base, and with its long-standing track record of innovation and consumer loyalty, PepsiCo remains a dominant player in its industry. So let's dive into why Pepsi could be an attractive option for dividend growth investors in 2025. 2024 was a tough year for Pepsi. Like many stocks, it took a dive towards the end of the year, landing at a 52-week low. Shares are now down 13% for the last 12 months. Looking at the 5-year total return of 27.39% and the 10-year total return of 107%, both are pretty well trailing behind the S&P 500. So you might be thinking, what the heck, Nick? And yes, Pepsi has underperformed compared to the broader market in recent years. But here's the thing. Pepsi offers a more defensive position in the portfolio. While growth is going to be slower than the S&P 500, Pepsi's strong brand portfolio, reliable cash flow, and solid history of dividend growth make it a safer bet. For investors looking for stability and less volatility, Pepsi has been a consistent and reliable option. It's a great way to balance out a portfolio, providing some defense when the market gets rocky. And right now, by quite a few metrics, Pepsi is looking to be undervalued. One of the most appealing aspects of Pepsi is its dividend growth. The company has raised its dividend for 51 consecutive years, earning its prestigious Dividend King status. This makes Pepsi one of the elite dividend payers in the market. On top of that, its dividend growth has been solid and consistent, increasing by an average of 7% each year. This kind of steady dividend growth is a big reason why Pepsi remains such a popular choice for dividend investors. And the dividend is well covered by both earnings and free cash flow. At 64% of earnings and 70% of free cash flow, things are getting a little out of control there for a few years on the free cash flow side, but it looks like Pepsi has gotten it back under control. Historically, they've been good at keeping this low. Simply Safe Dividends gives Pepsi a Simply Safe safety score of 93, rating it as very safe, reaffirmed on October 23rd, 2024, following the company's Q3 earnings release. In the recent article, they highlighted Pepsi's ability to adapt to changing consumer trends and noticed that its dividend coverage remains strong, reinforcing the stability of this reliable dividend stock. Pepsi follows a bit of an unconventional quarterly payout schedule, paying dividends in March, June, September, and January. In fact, investors will be collecting their next dividend of $1.35 per share on January 6th. The total annual payout comes out to $5.42 per share. Right now, Pepsi shares are yielding at a healthy 3.62%, well above its historical norm. This gives investors a rare opportunity to lock in a starting yield for Pepsi that we haven't seen since the drop during the 2020 pandemic. In fact, if Pepsi were trading around its historical dividend yield, its price would be between $171 and $209. While this doesn't necessarily mean that's where it's headed right now, it serves as a useful benchmark to keep in mind. And by PE ratio, Pepsi is also trading near historical lows. Its 5-year average PE is 24.0, while the current PE stands at 17.6. If Pepsi were to be trading at its average PE, the stock would be priced somewhere between $184 and $224. This offers another potential signal of undervaluation, potentially. Now, if we look at outstanding shares chart, outstanding shares have declined over the last decade. Not a whole lot of share buybacks since 2020, however. Outstanding shares have declined from 1.53 billion in 2015 to 1.38 billion currently, so it's at least a lower outstanding share count compared to 10 years ago. And financially, Pepsi is a very well-managed company. Its return on equity sits at an impressive 49%. And its return on invested capital is at 20%, so both numbers well above the targets we like to see. And if you look at the consistency in these graphs, it's just like clockwork with PepsiCo, a testament to its efficiency and reliability. In terms of debt, Pepsi operates with a net debt to EBITDA ratio of 1.84, which indicates it isn't overly reliant on debt and can comfortably manage its obligations, and the net debt to capital ratio of 0.65. And that's nearing the higher end of our preference, but Pepsi has made notable progress in reducing this metric in recent years, and it's clear that things are heading in the right direction when it comes to managing their leverage. So Wall Street analysts, they've set a price target at $180.27. This represents more than 20% upside from where the stock is trading right now. That upside potential is looking good to me. So I hold a small amount of Pepsi in the Roth IRA, and I'm thinking about adding to it this month. Hopefully the price stays in the range it's at so I can grab a few more shares of this classic blue chip dividend growth stock. What do you guys think about Pepsi right now? Do you think it's going to recover? Or will the rise of Ozempic and the shift to more health-conscious consumer choices, will it leave companies like Pepsi behind? Drop a comment, leave a like, help me out in the algorithm here as I'm working on rebuilding our channel here. I do appreciate it. Now, if you're thinking, yeah, Nick, CSX, that looks great. Pepsi, fine company, but look, I need some dividend income now. I got a stock for you. Let's talk about VICI Properties, ticker VICI. It's a real estate investment trust, or a REIT, that focuses on casino and entertainment properties, one of the largest owners of gaming properties in the U.S. VICI provides a unique way to gain exposure to the thriving gaming and leisure sector. Their business model is built on long-term net lease agreements with major operators in the industry, ensuring stable cash flow and offering an attractive dividend yield. With a strong portfolio of properties and a consistent track record, VICI is one of the more interesting options for those looking to invest in real estate with a focus on entertainment and gaming. 2024 was a challenging year for VICI Properties. Stock was down 9% over the past 12 months. Like many REITs, it faced headwinds from rising interest rates and market volatility, but this decline could present an opportunity for us long-term minded investors. Over the past 5 years, VICI has delivered a total return of 54%, and since its inception, the maximum total return is 136%. While the stock doesn't have a 10-year track record just yet, its performance since coming onto the scene has been solid, showcasing the company's ability to deliver returns for shareholders even amid challenges, such as when its tenants were all forced to shut their doors in the year 2020. Now, VICI Properties may be a relatively young company, but it has already demonstrated impressive dividend growth in its short history. Over the past year, the dividend has increased by 4.2%, while the 5-year average dividend growth rate comes in at an impressive 10%. For a company that's less than a decade into its journey as a publicly traded entity, this level of consistent growth is remarkable and speaks to the strength of its business model and the trust it's building with investors. As VICI continues to expand its portfolio and grow, the potential for even more dividend increases is something we're definitely counting on. The dividend makes up 75% of adjusted funds from operations, AFFO, which is similar to free cash flow for REITs. This is right in line with what we expect for a hotel REIT, and VICI has remained consistent in this regard, ensuring its payout is well supported by earnings. Simply Safe Dividends gives VICI a safety score of 50, rating it as borderline, indicating a moderate risk for a dividend cut over a full economic cycle. However, it's worth noting that VICI maintained its dividend even when all of its tenants were forced to shut down for months during the pandemic. So this score was reaffirmed on November 15th, 2024, following the company's Q3 earnings release. It's important to note that VICI's dividend is non-qualified because it will be taxed at a higher ordinary income tax rate than lower qualified dividend tax rates, which could affect net return for investors in their taxable accounts. Stocks like this are ideal for tax-advantaged accounts like a Roth IRA. The VICI Properties, they pay their dividend on January, April, and July, and October, with each payment being 42.25 cents per share for a total annual payout of $1.73 per share. Shares are currently yielding 5.87%, which is quite attractive and well above its historical average. If VICI were to be trading at its historical dividend yield, it would be priced between $31 and $37, suggesting that the stock could be undervalued. Additionally, the forward price to adjusted funds from operations, the P to AFFO, right now that ratio stands at 12.8, which is below a 5-year average of 14.5. Remember, when we're talking about REITs, we're focused on the P to AFFO instead of the traditional PE ratio. If VICI were trading at its average P to AFFO, shares would be priced between $30 and $37, further indicating potential undervaluation. And we are seeing a nice steady rise in adjusted funds from operations per share over the last few years. Adjusted FFO has risen from $0.37 billion to $2.31 billion since 2017. And look at that incremental steady growth. You gotta love it. A lot of investors are excited about owning this hotel REIT. Wall Street analysts currently have an average price target of $35.85 for VICI Properties, and that would represent a potential upside of 22% from its current price. And look, if you follow me, you know that I'm holding VICI in multiple places. I've got about 100 shares between it all, and I'm planning on adding more in 2025 if the price stays in my buy range, which right now that's below $31. And that's when I'm looking to pick up more VICI shares. Now, how about you? I know a bunch of you are in VICI, or you're in Pepsi, or you're in CSX. Are any of these stocks looking good to you right now? Drop a comment and let me know what you happen to be buying in the month of January. And if you click into this next video, I dive into another stock that's in a unique position to be acquired at a discount for long-term dividend growth investors. That opportunity is Nike, ticker NKE. This one's been beaten down brutally. So I hope you check that out. Thanks for sticking around. And until next time, my friends, keep investing.